Meet Pat Dorsey, the mastermind behind the Morningstar Moat rating. He's now managing a remarkable $840 million spread across 11 diverse holdings. In this video, we'll dive deep into Pat Dorsey's unique investment principles, the strategies that guide his decisions, and the impressive portfolio of Dorsey Asset Management. Pat Dorsey is the founder of Dorsey Asset Management, a firm dedicated to delivering long-term value and wealth preservation for its clients. Before establishing Dorsey Asset Management, Pat served as the Director of Research for Sanibel Captiva Trust, an independent trust company that caters to high-net-worth individuals. His role there was instrumental in providing strategic research and insights to drive client wealth growth. From 2000 to 2011, Pat was the Director of Equity Research at Morningstar, where he played a pivotal role in scaling the firm's equity research division. Under his leadership, the team expanded from 20 to 90 analysts, significantly enhancing Morningstar's analytical capabilities. Pat was key in the creation and refinement of Morningstar's economic moat ratings, a system designed to assess a company's competitive advantages. This framework drew inspiration from the investment philosophies of Warren Buffett, focusing on identifying businesses with durable, sustainable competitive advantages. In addition to his corporate achievements, Pat is an accomplished author. He wrote The 5 Rules for Successful Stock Investing, which serves as a comprehensive guide to smart investing, and The Little Book That Builds Wealth, which outlines strategies for identifying companies with strong competitive advantages. Pat's academic background is equally impressive. He holds a master's degree in political science from Northwestern University and a bachelor's degree in government from Wesleyan University. Further solidifying his expertise in finance, Pat is a chartered financial analyst charter holder, a credential that underscores his commitment to the highest standards of ethics, education, and professional excellence in the field of investment management. Pat Dorsey's investment strategy centers on managing a single, long-only equity strategy, which means that they invest in a select group of companies and hold these investments for the long term. This strategy focuses on concentrating client capital in 10 to 15 businesses that have strong competitive advantages, often referred to as economic moats. These businesses are chosen for their potential to grow shareholder value at above-average rates over many years. Pat Dorsey and his team seek to purchase these businesses at prices below what they believe the companies are truly worth, based on their intrinsic value. This involves finding companies led by managers who are skilled at using the company's capital in ways that benefit long-term, minority shareholders. Their strategy emphasizes investing in high-quality businesses and maintaining a disciplined approach to both valuation and capital allocation. Dorsey Asset Management does not limit their investments to specific regions. Instead, their portfolio allocation across different parts of the world depends on where they find the best investment opportunities. As a result, they may not invest in some regions for extended periods. While they value local insights when researching companies outside the United States, they also believe that having a global perspective helps them understand cross-border comparisons and value chains more comprehensively. The search for new investments at Dorsey Asset Management relies heavily on qualitative analysis. This means they look for characteristics that cannot be easily identified through numerical data alone. This is because the characteristics of the structural competitive advantages they seek, known as economic moats, cannot typically be identified through quantitative screens. According to Pat Dorsey, the fundamental aspects of an economic moat are the structural and sustainable qualities that are intrinsic to the business. A moat is an integral part of the business model, rather than just a popular product or an innovative piece of technology. It's not about having the largest market share. Size alone does not constitute a moat. Moats typically manifest through pricing power, the ability of a company to raise prices without losing customers. If a company struggles to increase prices, it likely does not have a strong moat. Conversely, losing pricing power often indicates that a company's competitive advantage is weakening. Pat Dorsey developed a classification for economic moats during his time at Morningstar, categorizing them into wide moat, narrow moat, and no moat. The idea is similar to the moat around a castle. The wider the moat, the better protected the business is from competition. He identified 4 types of economic moats that remain relevant today. 1. Intangible assets. These include brands, patents, licenses, and regulatory approvals that give a company an edge. For example, customers might prefer an iPhone over a Samsung phone because of the Apple brand. 2. Switching costs. These are costs that make it difficult for customers to switch to a competitor's product or service. Companies that integrate deeply with their customers' operations can create high switching costs, leading to long-term renewals. 3. Network effects. This occurs when the value of a product or service increases as more people use it. Social networks like Facebook are a prime example. 4. Cost advantages. Companies that can produce goods or services at lower costs than their competitors enjoy a significant advantage. This might be due to proprietary technology or efficient processes that are hard to replicate. So, Dorsey Asset Management's investment universe includes businesses with strong economic moats, such as high switching costs, network effects, and scale advantages, which help insulate high-returning companies from competition. This focus naturally leads them to prioritize certain industries where favorable structural economics are more prevalent. While economic moats are foundational to their investment process, Pat Dorsey and his team understand that moats alone do not generate shareholder value. Reinvestment opportunities that maximize the value of a competitive advantage and effective capital allocation are crucial elements in linking business value and shareholder value. The ideal investment combines all three elements: a moat to protect the business from competition, opportunities to reinvest capital to generate growth, and superior capital allocation to ensure shareholders benefit from the increasing business value. Pat Dorsey's valuation principles emphasize practicality and balance. First, they believe it is better to be approximately right than precisely wrong, avoiding the trap of false precision. Second, they recognize that valuation is a double-edged sword, balancing the need to maximize the margin of safety at purchase with minimizing the opportunity cost of not owning a business, with the potential for high compounding growth over the long term. If we examine the investment portfolio of Dorsey Asset Management as of Q2 2024, we see they manage approximately $840 million across 11 different holdings. The top 5 investments are in Meta Platforms, Smartsheet, Wix, AutoZone, and Alphabet. Meta, the parent company of Facebook, Instagram, WhatsApp, and Threads, has performed exceptionally well this year, with its stock price up around 70% year-to-date. Pat Dorsey heavily invested in Meta 2 years ago, adding approximately 234,000 shares to the portfolio at the end of Q4 2022, when the stock was at a low point. This turned out to be a brilliant move, as the stock has since risen by about 480%. Another strong performer in the portfolio is Alphabet, the parent company of Google, which has seen its stock price rise by about 30% this year. Both Meta and Alphabet derive most of their revenue from advertising, indicating Pat Dorsey's confidence in the growth potential of this sector. These companies exhibit key characteristics of economic moats, such as strong brand recognition, network effects, and cost advantages, particularly as online advertising remains significantly cheaper than traditional TV advertising. Smartsheet is an enterprise work management platform. Once a company integrates Smartsheet into its workflows, switching to a different platform can be challenging. This difficulty exemplifies high switching costs, which is a moat characteristics according to Dorsey's investment strategy. As the company expands and hires more employees, each new user requires a license for the platform, highlighting the network effects. However, it's important to note that despite these advantages, Smartsheet has not yet reached profitability. Similar to Smartsheet, Wix provides a platform for building websites. Once a business has set up its website using Wix, transitioning to a different platform can be difficult, reinforcing high switching costs. This stickiness ensures long-term customer retention. AutoZone primarily benefits from cost advantages. Its extensive distribution network and efficient supply chain management enable it to offer a wide range of automotive parts and accessories at competitive prices. While the portfolio as a whole aligns with the characteristics Dorsey Asset Management seeks in businesses with economic moats, there may still be companies with even stronger competitive advantages out there. What do you think about their investment choices? Share your thoughts in the comments below. If you enjoy these types of videos and want to learn more about the investment principles and techniques used by super investors, try out Wick Academy's training on how super investors beat the market by clicking on the first link in the description below. You can start for free today. That's all for now. Please leave a like and subscribe to the channel for more.